Thank you very much, Peg. You're back, and I'm back, and it's nice to see you again. There are a few people here that I actually run into periodically during the year apart from this conference. I think I see some of you more than I see my own relatives, but it's very nice, and I hope the relationship continues. It reminds me a little bit, the storyline is very different, but this goes back maybe 20 years ago. There was first a Broadway play, then it was made into a movie called Same Time Next Year. Most of you are too young to remember it, but in any case, for those of you who do remember it, this is what reminds me of it. It's always a pleasure to come back because you're all such nice people, and Experian puts on such a great show every single year. As usual, I have a lot to discuss. I'm going to try to leave time for questions. I have one story to tell you, but I'm not going to do it up front because I don't want to use the time. If we have time at the end, I'll tell it to you then. But let me give you some general outlook of where I come out and what I think is ahead, and then we'll talk about all the specifics in a moment. I don't think the economy is going to do what the Mets did. And that is choke and collapse. Well, not choke, but collapse. I know you're hearing a lot of gloomy forecasts these days. It's hard not to hear them. They're all over the talking heads on the TV programs, all the newspaper stories. Some of the economic statistics look weak. But as I'll tell you in a few moments, while this is not going to be the greatest boom in the history of the United States, and that's not going to be a surprise to you, and while there are some very serious problems in parts of the economy, also not a surprise to you, it is unlikely, in my opinion, that this is going to lead to the kind of deep recession or economic collapse that many of us fear, that has happened in the past on occasion in this country. But as you'll see in a moment, I think conditions are very different now, and that kind of outlook or that kind of occurrence, in my view, has a relatively low probability. Let me start with a very, very brief historical review and then talk about the most critical question now, or one of the most critical questions, and again take a different view than some other analysts and economists are now taking. And then it'll lead us into where we are now and what the outlook for the economy is going forward, and the outlook for interest rates and consumers and the things that you're very interested in. And I'll try not to repeat some of the stuff I know you heard at a presentation here yesterday. I think you all have a general idea of the rough pattern of the U.S. economy in the last 15 years or so, a little bit more than that. We had an extraordinary run of prosperity in the 1990s. We went the entire decade without a recession. 10 consecutive years of economic growth, not only a long period, the longest ever without a recession, but it was pretty strong economic growth. See, when you go that long without a recession and the economy's moving up at a rapid pace, you have a lot of prosperity, and that's what happened in the 1990s. And as soon as Business Week or some of the other publications printed their cover stories after that, gosh, the business cycle is dead and buried. We may never have another recession. Sure enough, about a week later, a recession started. And I think all of you know we went the first 3 years of this decade, from early in 2000 to spring or so of 2003, alternating between recession, stagnation, and slow growth, essentially a 3-year period of underperformance in the U.S. economy. And of course, those of you who remember the stock market, it was accompanied by one of the biggest declines in the stock market in our history. I think many of you also know that just when people were saying, my gosh, we're never going to get out of this mess, things began to improve. And it became noticeable in the spring of 2003. And ever since then, so we're now 4.5 years later, since this period of recovery and economic growth began, that's what's gone on. It's been a continuous, economic expansion. But that doesn't tell the whole story, because you can essentially split this 4.5-year period into two parts. The first 3 years, when the economy grew at a fairly healthy rate. Not the fastest recovery in our history, but it was certainly relatively good. And then the last 18 months, when economic growth, still positive, the economy is still moving forward, but economic growth, the rate at which the economy is growing, has slowed considerably. Those of you who have been here for the last 2 years remember we've talked about it a lot. And, our general number was that we would probably slow from somewhere between 3.5% and 4% per year economic growth in the first 3 years of this expansion period to something around 2%. And that's what's happened. It's almost exactly 2% over the last 18 months. So already the economy has slowed down some. And again, you know why. The housing sector, which created a lot of the upward growth we had earlier, was a big contributor to economic growth in the middle years of this decade, as all of you know, and for many of the reasons you know, but I'm going to give you a different perspective of that on that in a moment, has gone in the opposite direction. Housing is now falling, new construction is declining. It has become a drag on economic growth. And secondly, and obviously now you can hear me again, sorry. Yeah, obviously, industries related to housing have struggled since that time as well. And on top of that, largely because of higher gasoline prices, we've seen some slowdown in consumer spending, particularly the low-end retailers, because it's the people in the bottom half of the income distribution who live week to week who are most significantly impacted by higher gasoline and energy prices, because it takes purchasing power away from them that they would use for something else. So that's why the economy has slowed down. Now, one other thing about economic history I think is absolutely essential to focus on and to see why, in my opinion, the economy is not going to fall off a cliff like some others have predicted, and that's what's happened in inflation. You all have heard my view many, many times. In my judgment, there has been a sea change, and this economy has gone from having an inflationary bias, and anytime anything would trigger some inflation, before you know it, it would raise business costs, they would raise prices, that adds more to inflation, that would raise wages and costs again, and you would spiral up, and we used to call it in the old days a wage price spiral or a cost price spiral. And that's what happened, for example, in the 70s. Remember the first oil price shock early in the 1970s, which raised primarily oil products, gasoline, heating oil, etc. Well, before you knew it, that fed into some other prices of products that use energy in the production process. In addition, a lot of workers used to have automatic cost of living adjustments in their wage contracts. Almost every union did. So when prices went up, whether it was energy or anything else, that would trigger an increase in their wages. Well, the companies, the auto companies and the other industries where they had similar contracts would try to pass those cost increases onto their consumers by raising prices. So that added another layer of inflation on top of what we got from energy, and this would just cycle or ratchet upward and upward. And what was a bounce in oil prices in the early 70s led to double-digit inflation in this country, almost unheard of before. Well, it has changed dramatically. In fact, not only has it changed, I think we've gone in the other direction. Namely, this economy now has somewhat of a disinflation bias. And you all, I think, know many of the structural changes that brought this about, starting with the advent of global competition. Even if wages go up in the auto industry, the auto companies can't pass it on. Quite the opposite. If they don't give rebates or discounts, they don't sell any cars because they're competing with a whole batch of foreign companies who are selling cars in this economy. And this is true in dozens and dozens of other industries. Deregulation in many industries. Airlines, long-distance telephone service. Do you remember when AT&T was the only long-distance carrier in this country? It's only about 20 to 25 years ago that changed. Now there are dozens of companies selling long-distance telephone service. AT&T is practically out of the market. Not quite, but their share of the market has come down dramatically. Walmart, the advent of these big discount chains that operate every day on low prices. They don't accept price increases from the companies that supply their products. And they have great buying power. And they don't raise prices to consumers as a result. New technology. Look what the internet and a lot of the other new technologies have done in terms of reducing business costs. And on and on and on. There has been a sea change. And by the way, just one news item in the last couple of days, you saw that the UAW has negotiated a new contract with GM. Did you see any cost of living adjustments? Did you see any wage increases? No, it was all about givebacks. That's how the world has changed as a result of all of these factors. And of course, in the industries that have been deregulated, there's no longer monopoly pricing in air travel where, the airlines calculate the costs, go to the FAA to try to get some rate relief, which they usually got, and raise fares. It's now determined in free markets, demand and supply, and airfares have come down enormously over this period as a result. So there are competitive forces determining inflation and many prices, not monopolies, not regulation, as was the case in large segments of the economy going back. So very, very important. And I got to tell you, I mean, even Alan Greenspan, I saw, of course, he's, I guess, trying to sell books right now, but said something that I'm really worried about inflation going forward. What could he possibly be looking at? When you look at all of these factors and all the arguments that you hear about inflation are just plain wrong. Someone said the other day on one of the TV shows, well, gold prices have gone up. This means inflation. There is zero correlation between gold prices and overall inflation rates in this country. Gold goes up and down because of industrial demand. It goes up and down because of exchange rates. It goes up and down because it changes in interest rates around the globe and so forth. It is not an indicator of inflation, pure and simple. Well, commodity prices are high. Metals like copper and zinc and a lot of others. A lot of it being driven by new demand coming from some of the rapidly growing economies like China especially, even India, some other countries in the Pacific Rim. And this is supposed to trigger inflation, particularly given the downsizing of U.S. manufacturing. Do you know how small a portion of costs for most manufacturing companies commodity prices are now? They average maybe 2 or 3%. And even if they go up fast, and even if it creates some cost pressures, they can't raise prices if their competitors don't. Competition limits the increase in prices, even if costs do rise. And commodity prices are so small, other than oil. That's a different one, and I'll address oil in a moment. Then you hear the argument, well, the weaker dollar is going to trigger inflation because it means prices of imports go up, so that's inflationary already. Plus, it gives domestic companies more leeway to raise their prices because their competitors' prices go up. The added inflation coming from a weaker dollar probably shows up in the fourth digit after the decimal point. It is small, and again, many foreign companies, they'll just take lower profits than raise their prices, passing on exchange rate changes in the U.S. market. You don't know what the Japanese and Chinese do. They want to sell into the U.S. economy, and how much money they make on it is secondary. This is the way they drive their economy and their economic growth. So that argument has no merit. And, I can go down all the others. Some economists who still believe in the money supply, there's no correlation there. The fundamental point is that the inflation process has changed. Inflation is no longer a threat like it was. And just think back over the last year, and we talked about this at our meeting a year ago. We had a giant increase in oil prices. Crude oil has gone from like $15 to $20 a barrel. It's now roughly around $80. Gasoline prices have been at or above $3 for most of this period, double what they were. What has happened to inflation? We had a temporary spike a year or so ago as gasoline price increases worked through the inflation indexes, and as some cost increases in other industries because of higher energy prices, jet fuel being an example. The airlines probably passed on maybe a third of the jet fuel increases. That's how little they can pass on.